Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures fluctuating this morning after stocks closed out 2 days of back-to-back gains following the S&P's drop into correction territory. This move comes as investors have turned bearish on U.S. stocks, with an investor survey from Bank of America showing the biggest ever drop in U.S. stock allocation amid the growing trade war.
Plus, the other focus for investors here, the Federal Reserve. Traders will look for any clues on the central bank's path forward for rates as monetary policy. Those setters meet in Washington for their two-day meeting. The central bank is widely expected to hold rates steady as they wait and see the inflationary impact of President Trump's policies.
And shares of Nvidia moving to the downside this morning. That's ahead of that highly anticipated keynote from CEO Jensen Huang at its GTC Tech conference. Top of mind for investors, updates on the company's Blackwell product line, as well as commentary on gross margins, China, competitors, and growth overall. The chip giant's shareholders hoping that Huang can inject some much-needed optimism and momentum into the stock, which is down more than 10% this year.
U.S. stock futures are trading lower right now after the major averages saw 2 consecutive days of gains, but Wall Street strategists say the sell-off has more room to run as the downside for catalysts for stocks that remain. Joining us now for more is Yahoo Finance markets reporter Josh Schaefer here, and a lot of questions just about have we seen the brunt of the selling subside and what's the data telling us right now?
Yeah, Brad. So we've had about a 3% pop in the S&P 500 right over the last 2 sessions. But I think the thing that stands out and what strategists are talking about is what actually changed about the story to drive this narrative. Not much, right? A lot of people arguing stocks were oversold, so at some point maybe you hit some technical levels, maybe some incremental buyers come in. But I think when you look at the fundamental story that sort of brought us here and brought us to this drawdown, I don't think it changed that much. I want to bring up a chart that was in Bank of America's Fund Manager survey that you guys were just talking about. This is, of course, a survey of investors, so it sort of gives us an idea of what's top of mind for investors. But what was top of mind for investors from a risk perspective during that drawdown? It was the trade war, right? So the trade war, global recession was the top risk listed by investors. Then you had inflation causes Fed to hike as another risk. Doge sparks a U.S. recession. New political conflicts, AI bubble, all of these listed as potential risks to the market as we're selling off. I haven't seen anything in the last week that gave me any sort of confidence that any of those risks look any better, right?
Mm-hmm. Well, it's interesting because obviously we've seen these 2 days of dip buying, and the question that we wanted to pose to you is whether or not that's a sign of a rebound to the upside that's going to be long lasting, or if this is just something a little bit temporary here. And to your point, we do have news that Jamison Greer, who's going to be running the tariff side of things, is going to try to have some more policy clarity. And I think that maybe that gives investors a little bit of confidence, but we haven't seen proof of that yet. That's just reporting indicating that clarity. So is that going to be enough when, to your point, over half of those fund managers say that the trade war is the biggest risk to equities right now?
I think the point here, guys, we're talking about a sustainable rally too, right? Like a rally back to record highs. So a double-digit rally. That needs some sort of fundamental backing. People don't just wake up and buy stocks to buy stocks, right? You buy stocks because you think in the long run corporate profits are going to move higher. It's a bet on earnings. It's a bet on the overall U.S. economy here, right? Like that's why you would buy stocks. You need something that makes you feel more confident in that story based on what investors are saying about risk. It's probably more certainty on the tariffs, right? So then we can understand.
So what is this 2 days of gains that we're seeing that are obviously reversing in the trade so far this morning? What do you think has been driving that?
I mean, I think you look at some of the stocks that bounce back, it really was just the stocks that got hit the most, right? So if Palantir shaves off 50% of its value over a 1 month period, and then it pops last Friday, kind of just makes sense a little bit, right? That stock would still have to rally 100% to get you back to where it was at the most recent 52-week highs, right? So you're just seeing a little bit of nibbling at some of the bigger names, some of the more popular names that got fully unwound. But I don't think you're seeing actual confidence in the growth story. One final thing that I want to point out is just normally people would argue that the end of a correction and when you start to move higher comes on some sort of news event, right? You think back to last August when we had that growth scare. When did we really rally back? when we had a report on initial jobless claims on unemployment filings that was better than feared, right? So less people were filing. That gave you confidence in the growth story. It gave people a reason to come back in and buy stocks. Maybe it's the Fed tomorrow. Maybe there's something that Powell says that gives people a little more confidence. Maybe it's something from Trump. Maybe it's not until next month when we get to earnings season. But you need a little bit more of actual something to chew on.
You know, for the technological side of the trade here too, let's remember in different dramatic shifts that we've seen in technological advancements in the past, there have been long periods of sideways trading, especially if you move from the period that it is all hype, then proves to be a show me story over an extended period of time. You can point back to the .com, you can point back to even the cloud craze that took place earlier on where everyone was saying, okay, all we need to do is make sure that they know we have a cloud solution. Well, you still have a long run period of time after that hype phase where companies had to grow into those valuations. And so that might in the backdrop be also what we're seeing start to play out as well here early.
Yeah, when does the show me story kind of happen, right? Yeah. And I know you guys talk to a lot of tech strategists about that. There's not a lot of people arguing that you're going to see crazy profits from AI this quarter, right? It's probably end of 2025 into 2026. But what are those companies going to start saying about that process as we move forward, I think is going to be the key, Brad. I agree.
All right, guys. Thank you so much. Josh, thank you for joining us. Appreciate it. Federal Reserve kicking off its two-day meeting in Washington this morning with investors awaiting the central bank's rate decision and commentary from the Fed chair on the path forward for rates. Joining us with more, Kathy Jones, Charles Schwab, Chief Fixed Income Strategist. And Kathy, it's great to have you on. I'm curious, do you expect any commentary from Powell that could fuel investor optimism right now, given just the amount of uncertainty in this market about the path forward?
Well, typically Powell is sort of on the dovish side in his comments in the press conference, and I expect that might give a lift to the market or give some optimism to people about the economy and about inflation eventually coming down to 2%. So I think he will reiterate that he has confidence in the economy, that it's in a good place, and that's why the Fed doesn't have to do anything right now, and that they're confident they'll get to 2%. So he tends to be a calming voice. He tends to be relatively optimistic on the economy, and that may help optimism bounce up a little bit.
Powell, usually a calming voice, but he's going to have even more vocal critics around him, especially those who have the directive from President Trump as well to perhaps act as a conduit or a vessel for some of his own thoughts. How does Powell continue to strike that tone while at the same time knowing that there are going to be other speakers that maybe they're not taking the lectern after an FOMC meeting, but they also are going to be out there with their own spate of Fed speak as well?
Yeah, this is the line they always walk. The Fed can only communicate so much, and the Fed chair can only communicate so much of the point of view. When asked more challenging questions about comments or actions from the administration, Powell will have to craft some sort of response. And other members of the FOMC will have to craft some sort of response. They're pretty adept at that, at trying to maneuver around the politics of all this. But yeah, it's a challenging situation. There's a lot of cross currents right now. They'll try not to talk about fiscal policy. They'll try not to talk about tariffs, and indicate that they're just taking the information in and acting upon it as it comes in. But yeah, it's a real challenge because, there's always a risk you get someone from the administration saying one thing and the Fed saying another thing, and that gets challenging for investors.
Can the Fed afford not to talk about tariffs at this juncture? I know that they're waiting to see how that's all ingested by the economy, but to the extent that they can at least have some predictive analysis around what they would be looking for to signal how there could be some broader impacts towards their pathways in their dual mandate for full employment, which the Department of Government Efficiency is already going to have some type of move within the employment situation going forward in the government sector. And then you think about some of the other mandate, the other side of the mandate, and the inflationary side, where there's clearly going to have to be some impact from tariffs.
Yeah, we have heard some comments from the Fed about tariffs that they're initial response or the traditional response in the past has been to look through them because it's a one-time price increase. But they have indicated that they will take a look at it once they get the full range of tariffs, because I think the risk in this situation on tariffs is it isn't just a one-time price increase. If you're using tariff policy, over the course of several years, then it's one price increase after another price increase after another potentially, which does turn into a real inflation problem long term. So I'm sure that the Fed is doing that analysis right now. They don't want to speculate or answer a lot of hypothetical questions until they have the factual data. But my inclination is to say this time around, they're not simply going to look through tariffs because they're so broad-based and so continuous. On the employment side and the DOGE cuts, I'm sure that they're doing analysis on the employment prospects based on what they know. We know that about 2% of the workforce is federal government workers. That hasn't changed in a long time. But the incremental impact of those cuts on contractors at state and local government levels when programs are being cut, that has an impact on employment. And, private sector forecasters are looking at it. I'm sure the Fed, with all its PhDs, looking at it as well. Can they comment on it? Again, at this point, it's relatively speculative because we don't know how the numbers will play out, but they can comment to the extent that it's a concern and something that they're looking at.
And Kathy, talk to me about bonds as kind of a cheap diversifier here. To what extent are you anticipating that all of these factors, including what you mentioned as a trade war instead of a one-time inflationary impact of tariffs, how could that impact the bond market? How should investors be thinking about positioning in the bond market off of that?
Yeah, it's a mixed bag for the bond market. On the one hand, tariffs raise prices and potential inflation down the road, but they also slow growth, particularly when you get retaliatory tariffs. And we have other factors such as the DOGE cuts potentially slowing growth as well. So in the long run, I think that this is positive for the bond market. And we're seeing some bid on days when the stock market goes down for bonds as a safe haven, which makes sense. On the other hand, because there's potential inflation on the horizon, we're being pretty cautious about extending duration right here. At 4.25, 4.30 or so, 10-year yields look to us okay, maybe well balanced between those two forces. But we don't really want to extend duration in case the inflation pressures show up before the growth slowdown shows up. And that's the debate going on in the market. So, we're advocating what we call a benchmark duration. And for us, that's the duration of the aggregate bond index. That's around 6 years. Has a yield to worst of about 4.65%, 4.7, I think, this morning. That gives you a high quality investment grade portfolio or portfolio index with not too much duration, but enough to take advantage of the yield that's offered. And the yield is pretty decent as a baseline. And then I would add other asset classes around that, but be really cautious about credit because in this environment, if we get a real growth slowdown, then I think those spreads and high yield in particular will continue to rise.
Kathy, thanks so much for taking the time here with us today. Really appreciate it.
Thank you.
Nvidia CEO Jensen Huang takes the stage today for the company's annual GTC conference. Our very own Dan Howley is on the ground in San Jose, California, and he tells us the latest that we should be expecting out of this. Dan, bright and early for you. Thanks so much for hopping on.
Yeah, bright, not so much. Still dark outside here. But the big thing that we can expect out of this event really is more news on what Nvidia has cooking up with its next generation chips. Now, there's reports that, and honestly, previous inklings from Nvidia itself that we'll see their next generation Blackwell Ultra chip. Now, that would be the successor to Blackwell, which is the current lead chip that Nvidia has. And then also, we're hearing that we could see more of what they call Vera Rubin. And so Jensen Huang had shown off previously a roadmap of where NVIDIA's chips are going. And that would be the next level of the chip, and an all new platform from what they have as Blackwell now to Rubin. Vera would be the successor to their Grace CPU. And these are all things that NVIDIA has previously kind of shown off, as I said it at other conferences, kind of showing what their roadmap will be moving forward. Now, in addition to that, they're going to have their very first quantum day. This is going to be focused on quantum computing. Jensen Huang had kind of raised eyebrows when he said that a practical quantum computer is still, decades away. Some in the quantum computing community said, no, it'll be, 5 to 10 years. Sundar Pichai had said something along those lines. I've spoken to experts in the area, and they've said, nobody really knows. It's basically up in the air at this point still. Quantum computing is still kind of being researched, not necessarily something that's going to be practical in the very near future. But again, there's just predictions, and that's all they are at this point. And then finally, we expect NVIDIA to reference DeepSeek. Now, DeepSeek obviously kind of raised fears on Wall Street that AI companies were overspending when they said that they only spent a few $1 million to build out their DeepSeek AI models versus the hundreds of millions that Silicon Valley companies have spent. There's been kind of controversy around whether or not that's accurate, whether that it was more than a few $1 million because this was kind of distilled from other models. But the reality is NVIDIA has been pushing this idea that these are reasoning models, thinking models, similar to OpenAI's O1 or Google's Gemini Flash thinking, and that when they are doing this thinking or reasoning, they require a lot more horsepower than you would otherwise have with other models, more basic predictive models. And so that would benefit NVIDIA because it would mean that more companies would have to spend more on AI chips to power those models. And so that's going to be something that you would expect NVIDIA to kind of hammer home at GTC. And then I'm sure you can expect plenty more software updates that NVIDIA usually rolls out. This is going to be a big showcase. If you watch their CES keynote or their keynote last year at GTC, you know that they're chock full of information, and you can expect Jensen Huang to dial in on all of those.
Yeah, it couldn't come at a more important time. We saw 90% of the market recovering yesterday. The names that didn't recover, all of them big tech. Dan, thanks so much. Really appreciate it. Also, stay tuned for Yahoo Finance's special coverage of NVIDIA's GTC conference beginning today at 1 p.m. Eastern. Coming up on the morning brief, we'll count you down to the opening bell on Wall Street. Plus, we break down the outlook for Intel as investors looking for a show-me story from the company's new CEO, and a look at Tesla and growing competition in China. We'll discuss that and much more on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's check in on TSLA, Tesla. Those shares falling after Chinese automaker BYD unveiled a lineup of electric vehicles that it said can charge almost as fast as it takes to refuel a regular standard combustion engine vehicle car. Now, separately, RBC analyst Tom Narayan slashed his price target on Tesla to $320 from $440, citing lower estimates for the pricing of its full self-driving technology, FSD, and robotaxi penetration here. There you're seeing shares of Tesla down by about 4%. Notably, he is one of the bulls on the street on Tesla here, bringing down his price target, but still implies upside even from the marker that we are at right now, $228 a share pre-market.
It's interesting. There's a lot to unpack here. I think one of the things is, of course, that we are seeing this continued sort of disclaimer that we could be seeing buyers kind of delaying their purchases of Teslas amid new models expected to come out, like the Model 2 and the refreshed Model Y, which Narayan did mention could positively impact Tesla in the second and third quarters of this year. But I think, and you'll tell me what you think, Brad, but I think the sticking point here is how much money he anticipates Tesla being able to make on a monthly basis for their full self-driving technology. They previously thought that the company would be able to ramp back up to the $100 $60 a month by 2030, given some of the options that Tesla had put forward in the past. Now he's anticipating a decline to $50 a month for that full self-driving technology, and also anticipates lower market share for their FSD tech as well.
I will tell you what I think about this because you asked. So spot on with what they were anticipating, and it comes back to the demand profile right now. And you have a few things that are happening. One, in China, where Tesla is banking a lot of being able to deliver directly into that region, you're seeing even more of the homegrown competition maintain mind share, maintain market share, and actually grow out on both of those metrics. So all of those things considered, it's actually going to take us into a story that we're about to talk about in a hot second. So stay tuned for that, BYD, hint, hint. But all those things considered, it's not just what's taking place in China within the mind share and the market share, it's also the rolling back of some of the credits in some of the larger trade partner tit for tat tariff wars and spats that are continuing to be in negotiation right now. Looking at you, our neighbor to the north, Canada, and Toronto specifically, where they're going to be rolling back some of those credits. That could be a near-term hit and bearish signal right now for Tesla shares.
A lot of headwinds, but one potential beneficiary of the headwinds that Tesla's facing, BYD. BYD announcing new electric vehicles that it says can charge in about the same amount of time it takes to pump gas for a normal car. The company says its Super E platform will allow cars to achieve about 249 miles of range with just 5 minutes of charging. That's compared to the Tesla superchargers, which can provide up to 200 miles of range in 15 minutes. BYD will start selling cars with the new technology next month. It is impossible to overstate how big of a deal this is because the charging lag time has been a huge headwind for Tesla, and we're seeing competitors coming in and saying we can do this faster than you can.
Yeah, there's a term for it, charging anxiety, folks, and it's certainly played out here in how the automakers are trying to deliver more of that speed and efficiency to offer a similar type of experience to if you were just going to Buc-ee's for the people who are in Texas, or for the people in Pennsylvania, if you're going to Wawa to fill up. They're trying to make sure that it's a similar amount of time, regardless of whether or not you're going inside to get one of the hoagies during Hoagie Fest. All those things aside here, the charging anxiety has been a sticking point here, and we've seen it in recent years kind of back off a little bit. But as of right now, I think for the Super E platform, one of the main competitors, it seems like it's Mercedes-Benz. But how many people are buying a Mercedes-Benz CLA EV? That one offers 325 kilometers in 10 minutes for its charge. So that is one of the closest competitors as of this juncture, and we'll see how some of these efforts continue to ramp up to reduce that charging anxiety.
A lot of competition, that's for sure.
All right, shout out to the Wawa and Buc-ee's folks out there. We're also watching Intel this morning. The company's new CEO, Lip-Bu Tan, officially takes over today and is reportedly considering significant changes to its chip manufacturing methods and artificial intelligence strategies. Joining us now, we've got Patrick Moorhead, More Insights Strategy CEO and Chief Analyst. Patrick, good to see you here this morning. Thanks for waking up early with us. What are you expecting from the new CEO of Intel?
Yeah, so I've read all the emails, I've read the reporting on it, and what I think, the only thing I know first and foremost is we will see some cost cuts. There was some emails that talked about a world-class foundry, but that doesn't mean that they don't create it and then sell it. And then the only question is when. And one thing we have to remember in semiconductors is deals can happen, acquisitions can happen, but then you have to execute it, integrate, and that typically takes years. And you can cut costs too, which Wall Street loves, but it takes time and processes need to be changed. And unless you're exiting a business in mass, you have to do that. I don't see any current businesses that Intel is in that you would just exit.
Patrick, I remember last September, you told me Intel was just too cheap to ignore. And if investors had been listening to our conversation, they'd have made a lot of money based off of that call here. Do you still view this stock as a buy, even with the run-up that we've seen in the past few weeks?
I do believe that Intel is undervalued, and I think it is because investors aren't fully incorporating the value of their next generation process, which is called 18A. And 18A determines performance of the chip, it determines cost of the chip, it determines the power of the chip. And Intel has been very public, and we have seen some industry comparisons even to TSMC's latest process, which will come a year later after Intel, and it's on par, if not beating TSMC on pretty much every one of those variables for larger chips. So yeah, I think, it was an easy call when it was trading below book value and we didn't know as much about 18A. It's much easier call right now that we see details on 18A, which are quite positive.
Patrick, I know you're heading to the GTC conference today. You are there on the ground speaking with us. There's this existential question right now about whether there's too much money being spent on AI, DeepSeek fueling those concerns. Do you anticipate Jensen Huang being able to meet that question with an answer that investors will like enough to see a little bit of buying in the tech space today?
I think we will hear a lot about DeepSeek and other types of technologies like it. And the facts are that when DeepSeek came out, the spot prices for Nvidia H200 and H100s actually went up and supply went down. That makes a lot of sense because when you look at what's called test time compute inference, you could look at 10x the type of technology you need on the inference side to make that happen. And we're seeing this play out today. And then I look at CapEx from Mag 7, which despite all of the pressure, every one of these companies doubled down on their 2025 CapEx levels. And I think what Jensen and Nvidia has to absolutely nail is, first of all, Blackwell, current Blackwell B200, all the deployments are going great, right? We saw the 11 billion number last quarter. Let's see the momentum here. And then talk about the next generation Blackwell, which is lovingly referred to as Blackwell Ultra, which is a second half phenomena that you would expect a lot of performance and efficiencies from the hyperscalers. I want to see who stands up with Jensen and says, we want Blackwell Ultra. That will make a big difference to the way that I look at this.
Yeah. One thing we know he will nail is the black leather jacket fashion. Patrick, thanks so much for taking the time.
Thanks for having me on.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief.
And that's your opening bell on Wall Street. Let's get you a check on the markets here. You've still got selling pressure happening this morning off the back of the market being able to break that 4-week stretch of losses. We saw 2 days of trading to the upside. We had our markets ending in the green, and this morning we're coming off of those highs. You can see here that we saw just a little bit of movement to the upside following the fact that we had entered into correction territory, if I can pull this out. So you see this huge drop down, and then we did see a little bit of buying, just 2 days worth, and now this morning we are coming off of those highs just a touch here. You've got your S&P 500 down about 0.5%, but your tech-heavy names in your NASDAQ down about 0.8%. A big question is whether or not some headlines coming out of that Nvidia GTC conference are going to be enough to bring in some buyers to these big tech names. I thought it was really interesting on Monday. We did see that buying coming in here into the market. We saw about 90% of the S&P 500 move to the upside. What didn't move to the upside? These big tech names, and you're seeing that continuing this morning. Apple, the only gainer on the Mag 7 so far. You've also got the likes of Nvidia down 1%. It appears that Tesla is, of course, continuing to be our biggest loser among the Mag 7. That off the back of that price target cut from RBC, as well as some competition from the likes of BYD. But interesting to see Apple moving to the upside, perhaps off the back of some news from them in terms of deal making. We'll also be discussing the outlook for deal making moving forward here. I just want to lastly end by taking a look at the Treasury market here behind me, because it's been interesting to see some of the economic data this morning pointing to increased manufacturing and production in the United States. We saw that leading the 2-year above that 4.3 level that it's been hovering at here. You can see right now it's at around 4.32. Let's get to more with Yahoo Finance's Jared Blickery. Hey, Jared.
Thank you, Maddie. I like how you were highlighting yesterday as one of those 90% up days in the market. S&P 500 also had one of those days on Friday, so that's 2 in a row. That's an impressive leap off the bottom here, and we're looking at a 3-day view of the S&P 500, still holding on to gains of 2.35%, although that is less than we had yesterday. So a lot of times we talk about turnaround Tuesday. Things don't have to turn up on Tuesday. They can turn down too. It's Tuesday to Thursdays is when you tend to get that trend for the week. Let's take a look at small caps real quickly. S&P 600, excuse me. That's only down 0.6%. We actually have the NASDAQ down a little bit more than that. The Russell 2000 futures were leading to the downside in the early market, in the pre-market. But let's get to the VIX here. I've been tracking that. It's up a little bit off of the lows here. And again, this is a 3-day view, but not very much. The important thing is that we've been coming down off of the highs. This is a 1-month chart, and you can see the high in relation to where we are right now. Be nice to get below psychological number of 20, but that's not a huge deal for the markets. And let's check out the sector action, and we'll go over here. We can see financials and energy, the only two sectors in the green. Consumer discretionary, which has been very volatile since the election for that matter. That's leading the way down about 1%. But I've been watching energy, which is leading over the last 3 days. It's also up today. It's up 5% over these 3 days, followed by financials. So we have an interesting mix of outperformers. You can throw real estate, tech, and industrials in there too. So some cyclicals getting love as we finally find our feet, and try to find our feet, I should say, in this little rally that we have going on here. Let's take a look at the Mag 7 real quickly. This is over the last 3 days, so you see a lot of green here. Not what we're seeing today. A lot of the Mag 7 stocks under pressure. Apple bucking the trend there. But you can see Tesla, another decently sized down day, down about 4%, but still not below recent lows. And I do want to get to futures before I go here, because we have gold. Gold is rallying really nicely. It's up another 1.21% to 3,043 right now. So it is just forging new territory, fresh record highs here. This is a year to date, up almost 15%. And it's been a very steady run for gold. And we can also take a look at silver, which is now at a 4-month high. That's at 34.75, but that is knocking on the door of some levels that we haven't seen in quite some time. I think you need to go back, once we clear the recent highs, you need to go all the way back to the post-global financial crisis era, and that's when you saw $50 silver, and we're still about $15 from that intraday high. Toss it back to you, Brad.
Jared, thanks so much. Really appreciate it. It's time now for today's strategy session. Investors increasingly expect value investments to beat out growth over the next 12 months, according to the latest Bank of America Fund Manager survey. The percentage of investors who see value outperforming jumped to 45% in March, the highest level since January of 2023. Where within value is the best place for investors to be? That's the big question, and we pose that question to our next guest, Michelle Schneider, MarketGauge.com Chief Strategist. So Michelle, good to see you here this morning. Where is the best place to be in value right now?
Well, I think you have to divide value to hard assets versus companies that might actually be able to sustain whatever is coming to us, with its tariffs, interest rates not really necessarily going down, talk of recession, stagflation, and that's commodities. And I don't think there's enough discussion about it, but if you take a look around the board, besides what Jared just mentioned with all of the energy stocks, we're seeing corn, wheat, sugar, copper, even uranium and lithium starting to bottom out here. So I think people have to kind of change their mindset a little bit and kind of look at some of those hard assets in commodities, number one. And then as far as others, what we're really looking at in terms of equities, Brad, is how things that are emerging from bases are looking on a breakout, as opposed to what we've done for the last couple of years, which is buy every dip in the growth stocks. And I think that's where the broadening out of the market, or the value play, is what people are focused on.
And talk to me about being focused on value in this environment where we did see stocks moving to the upside for 2 days in a row. They're moving back to the downside today. Do investors still need to think defensively by looking at names in value, or are we going to see more buying leading us back to gains? Is this going to be a rebound that has legs in your view?
Well, right now, I think if you really want to look at one thing to give you that determination, it has to be the consumer sector. And so we like to look at XRT because it's a very good combination of staples and discretionary. XRT got beat up to a pulp most recently, had a nice move up with the rest of the market yesterday, but it hasn't really done anything to wow. In other words, it's so far from major moving averages. It had a major breakdown on weekly moving averages. And so if we can see that get legs, I actually think that's a better barometer than, say, Nvidia. I mean, that could help, but I don't think growth is what this market is looking for at this point. They don't want to see it collapse. I think they need to see some confidence in the consumer area. Transportation would be another, and small caps. That represents the inside sectors of the U.S. economy, and people are looking to see if they actually can sustain and rally as a result of all of these administrative policies that have been set forth. Not, of course, DOGE being one and tariffs being another.
So I hear you saying consumer health is a better indicator of where the market is heading than the performance of Nvidia. How does that play into the trade? I know one trade idea that you sent over to us is the vanity trade. Talk to me about what names might be beneficiaries of consumer health, even when they're being choiceful in the retail space.
Well, this is a great example of things that have really fallen apart, but might be basing out. So if we just look at the diet drugs themselves, the two companies, of course, Novo Nordisk and also Eli Lilly. Eli Lilly is doing better in terms of the technicals, but Novo Nordisk is another one not to ignore. It had sold off recently because it didn't do so well on a trial, but as much as people expected, but it has gotten some upgrades. So that would be, I think, the sort of the base of what you're looking at in terms of the vanity trade. As far as spreading out from there, we're looking at Ulta, we're looking at Elf, we're looking at Estee Lauder, we're looking even at Match.com. Anything that the consumer can switch to, okay, now I've lost weight, I have a way of keeping it off, and I'm starting to feel better about myself. AbbVie has been a big winner this year as well. So just think in terms of skin and beauty and health, and even athletic wear, and that's kind of what we're waiting for. But we're not rushing. Obviously, the overall macro right now is more of a concern, but these would be the places we would go if we think things are settling down.
Mish, I'm just trying to keep the weight on right now, honestly. I've got all the Create gummy ads all up in my feed right now at this juncture. But, one thing that you mentioned a moment ago was the U.S. consumer and specifically what we should be watching as the consumer is evaluating so many things, whether it be job prospects, whether it be the impact of tariffs as passed through to inflation. But one of the outside U.S. plays that you're looking at is actually in Vietnam. Why is that?
Well, Vietnam, first of all, they have made deals with the U.S. concerning tariffs where they're actually having better trade practices with the U.S. so that they will avoid tariffs. That's number one. Number two is China is actually doing a lot through Vietnam to avoid tariffs. And the country itself is a very highly industrious country. Their GDP is pretty strong. As we know, labor is cheap and they produce a lot. So that is an area. Now, again, here's a classic example of things that have crashed versus things that have based out and rallied. If you look at VNM as the ETF, which is the way to trade it, you can see that based out, broke out, then now it's above all its moving averages, and it's doing a little bit of consolidation here over the 1250 level. I don't see any reason why that can't go higher, but I would say probably 1250 is what I'd like to see it hold around at this point.
Michelle, 45 seconds. What are you doing with the Mag 7?
Nothing. Really, I mean, I think that to me, they could go up, and certainly I'm watching Nvidia carefully. Obviously, it had a nice bounce from the lows, but this to me is a representation of, I'm trying to put this delicately, of pointing people to, yes, AI is real, of course, and all the Mag 7, I mean, obviously Amazon, Apple, et cetera, are good companies with great balance sheets. But I also think that in terms of valuation, we don't really know valuation versus stock price and the overall sentiment. So we're staying out of it right now.
All right, Michelle, thanks so much for joining us. We appreciate it.
Thank you.
As we head to break, let's check in on shares of Apple. Apple lost its appeal to overturn a German regulator's decision to put it under tighter antitrust scrutiny. The court ruling that Apple's market footprint meets the threshold for more oversight. The ruling is a setback for Apple amid a broader pushback by big tech against European efforts to regulate their market dominance, with other U.S. tech giants like Amazon, Meta, Google, Microsoft also facing increased oversight. That said, Apple is the only member of the Mag 7 moving to the upside in this morning's trade so far. We'll have more markets action for you next. Gold hitting another all-time high as investors flock to safe havens with reignited tensions in the Middle East and weak economic data. Oil prices ticking higher after hitting 6-month lows earlier this month. Joining us now for a broader look at the commodities space and commodities investors should be considering. We've got Daniel White, Blue Line Futures Head of Research. Daniel, great to speak with you. You sent us 3 commodities to buy: soybeans, gold, and crude. I want to start on gold because we hit another record high, holding above 3,000 over the past 24 hours here. Do investors still have time to get in on gold?
Yeah, I mean, we're sticking with our longs. We're kind of riding the momentum here. We see de-dollarization continuing. The one thing we're eyeing on our gold longs is, resurgence of dollar strength. If you look at a dollar index chart, that's somewhat consolidating. So that's our kind of what we have our eyes on now. But we're riding the momentum with a stop below 29.74 right now.
Okay, and so how high do you see it going?
I mean, I generally don't like to forecast out, future prices because you never know what can happen. 3,500, I think we definitely look to take profits, but I'm not going to give you a concrete price forecast right here.
Okay, that's fair enough. That's a price target. We'll accept that, and that is perhaps a trade initiating marker, at least, that you're looking out towards in the future.
Yeah, absolutely.
Well, let's pick up on gold then. Let's pick up on oil because this is another commodity you recommend that folks buy. Why should folks be getting in on crude given all the volatility that we're seeing, obviously, in terms of tariffs, but also geopolitical tensions?
Yeah, well, I sent you those notes yesterday. The picture has somewhat changed this morning. Israel launched strikes on Gaza, Lebanon, and Syria last night, early this morning. So there's been a reintroduction of geopolitical risk premia into pricing. So to us, that really makes the upside more attractive. Generally, we've liked crude. Global inventories have been running close to 10-year lows on a seasonal basis. The bearish sentiment comes from the forward-looking balance sheet. So right now, markets are fairly tight. So with the introduction of geopolitical risk premia, we really like that contract here.
I mean, especially considering the fall apart in some of the ceasefire that we've seen, how do you see that continuing to overflow into the oil market?
Generally the models I've been looking at, there's a significant lack of geopolitical risk premium priced in. So I think that this could have some legs. The one thing to watch out for is a possible Russia-Ukraine ceasefire. That doesn't mean Russian barrels are going to flow back to the market right away, but I think that headline risk is something you definitely have to keep an eye out for.
That headline risk could come as soon as this morning. We know that President Trump was expected to be speaking with Putin this morning at 9 a.m. from the White House. We haven't gotten reports from that conversation yet, but we are expecting to hear lifting of sanctions. Potential truce is on the table. How do you avoid pricing that into your call?
Generally, we're sticking with calls and call spreads. In the May contract, we like the 71.75. I was pricing that up around 67 cents this morning. You kind of get your upside, but you can avoid, any type of catastrophic downside risk.
Great. Let's end on soybeans. That's your third and final commodity to buy. What's the bull case?
Soybeans. So we're going back to NOVE. That's new crop soybeans. Planted acreage this season is looking light, around 84 million acres were the Feb estimates. We think that could be lower, around 83. We like the $11, $12 call spread. If you get the growing season, you're good for at least one weather scare. And there's a Trump G summit being talked about for June. We're not necessarily betting on this heavily, but if there is talk of a possible trade deal with China, we would likely see a reinstatement of the phase 1, which would increase soybean purchases, hopefully drastically.
Dan, thanks so much for taking the time here this morning.
Thanks, guys. I appreciate it.
We've got much more ahead on Yahoo Finance. Stick around.
Elon Musk's SpaceX is bringing home 2 astronauts who've been stranded on the International Space Station since last June. Astronauts Barry Wilmore and Sunita Williams arrived on ISS June 6th of last year on the Boeing Starliner's first crewed mission. SpaceX Dragon ship left the ISS just after 1 a.m. Eastern this morning and is expected to touch down in Florida around 6 p.m. Eastern this evening.
NASA's original plan was for the astronauts to stay on the space station a little over a week and then take the Boeing spacecraft back to Earth. Officials deemed the return trip too risky for the astronauts as problems arose with the Starliner's propulsion system, though the ship successfully flew back on its own in early September. President Trump celebrated the return mission, saying in a post on Truth Social that he spoke with NASA's acting head to approve bringing the astronauts home 2 weeks earlier than previously scheduled.
Let's get a quick check on the markets before we head to break. It looks like your tech-heavy names are dragging down the major averages here. You can see that playing out. You've got your S&P 500 down 1%. Your tech-heavy NASDAQ responsible for the majority of the losses here. You've got the likes of Tesla, Palantir, and Strategy, formerly MicroStrategy, being the biggest losers amongst the NASDAQ right now, as you're seeing a risk-off trade continuing in this market here. That's going to do it for the morning brief. You can join me next hour for more analysis on Catalyst, and then you'll have Brad for Wealth after that. Stick around.